Well, hello again, everybody. And this video I'm talking about today is about the bear market in energy. And it clearly is a bear market. Now, most people would look at the price of oil or the price of a gallon of gas and note that it has changed drastically over the last year. The chart here is the 44 energy companies that are in the S&P 500. And these 44 companies year over year, all but 3 of them are down. One company over here just went public a few weeks ago, so it's not included in the data. But so 40 companies down, 3 companies up in the last year, and those 3 companies up are Marathon, Tesoro, and Valero. Everybody else is down, and in some cases 50, 60, 70% year over year. So this has really been a tough market. So I'm going to go over here real quick. The reason I've been studying energy is really lately I've gotten attracted to the dividend yields. And here are the dividend yields for some of the energy companies, well, all of them in the S&P 500. Some like Chesapeake recently announced that they were eliminating their dividend. And one of the things that got me curious is I'm the type of investor, if I see a dividend over 5.5%, it garners my attention. I've actually been keeping my eye closely on OKE. I am far from pulling the trigger on that. But at 6.4%, it certainly is attractive. Denbury Natural Resources is a company that you saw in the last charts down 78%. Frankly, with the valuation that it's at right now, the street does not think this company is going to make it. Therefore, it's probably not wise for me at this time to look at that as a possible venture. Although I am doing research and following it closely because it could become a huge, what I call risk opportunity, where you take a stab at something that everybody thinks is going to fail, and then if it makes it, you make a decent amount of money. Noble Energy just came off of the S&P 500, as a matter of fact, and their dividend, usually when I see something this high, I know that it's about to be cut. So I don't take too much credence in it. But over the next few weeks, I'm really going to be looking at this bear market in energy and looking at dividends and seeing that if any of these dividends are sustainable. Because really what they're going to end up doing is putting a floor in price. However, one way I'm going to look at that is look at the price to book ratio. And like I said earlier, Denbury priced at 25 cents on the dollar for book value. I mean, that's outrageous. That certainly is a company that the street thinks is not going to make it. Interestingly enough, you got Chesapeake Energy over here at 40 cents on the dollar. They are actually a little bit stronger than well, they're much stronger than a lot of companies right now. They're sitting on a lot of cash. However, there's still some concerns about the debt that they've leveraged up when they grew during the energy bull market. So another company that the street is clearly concerned about. The reason I look at price to book value and I compare them to dividend yields is in the event, let's take ExxonMobil for example. It's trading at 2 times book value. Let's take a look at the dividend yield, 3.69%. Basically what that means is if you take the price to book ratio and you multiply it by the dividend yield, that tells you the percentage of equity the company must pay out per year to keep the dividend sustainable. And so for a company like ExxonMobil, we see that would be 7.4% essentially. So then, what I would want to do, and unfortunately I can't do it right now, I would want to go over, well, yes I can, go over to return on equity. So ExxonMobil is earning more than that 7% return on equity. Its return on equity is 13%. Therefore, I could see that ExxonMobil's dividend is likely pretty sustainable. I'm going to look at other metrics such as cash flow as well to see if that's the case. So Dividend has sort of attracted me to energy at this time, but I also wanted to take a quick comparison here. I want to show you something else. I took Noble Energy off of this chart. This chart shows in black today's dividend yields, and in green to the right of the black is the dividend yields from a year ago. And you could see notably two companies have cut dividends, one being ESV, the other being RIG, Transocean. Again, these were likely situations where the dividend was not sustainable, but I wanted to see this, and I wanted to see really how dividend yields have evolved in the energy market over the last year. And OKE is another one, now up from 3.5% to 6.4%. Let's take a quick look back at OKE's price to book value. So they're priced at 2, so they need 12.8% return on equity, and they're getting 5.6. Now see, that tells me right there that OKE's dividend likely is not going to be sustainable because they're not earning enough to make their dividend payments, and so that, just like Noble Energy, is sort of an outlier. But I'm going to keep moving around over time and taking a look at other ones. Kinder Morgan's another good one. KMI, 5.66%. And while that's an attractive dividend, a year ago the dividend was near 5% in a much more favorable energy market. So let's take a look at Kinder Morgan's real quick. Kinder Morgan's return on equity right now, 4.74%. So they're coming under earnings pressure as well. And interestingly enough, like I said, and I'll take a look at OKE's as well. I want to also look at some of the cash flow metrics and make sure that these dividend yields support the company long term. I hope you enjoyed this video and the statistics in it, and hopefully there'll be follow-up videos in regards to the high dividend yields in these specific companies, and I'll appreciate any questions or concerns you have. Have a great week ahead.